Right, I think we'll make a start. So welcome everybody to our penultimate RedeConnect 2026 webinar entitled Succession Management, a View from the Front Line. Succession management is at the heart of a central paradox within private market investment. LP's desire for continuity and stability within GP leadership teams, on the one hand, most clearly manifested through key person provisions, and their increasing focus on effective succession plans, firm evolution, and resilience and generational transition on the other. It's also been one of the core drivers of a central theme of GP development over the past 10 years, GP staking, GP financing, and increasingly GP M&A. Hence this discussion taking place within the capital solution stream of RedeConnect. I'm Magnus Goodlad, and I co-lead the capital solutions practice here at Rede, where we're active advisors on such transactions as part of long-term GP franchise building. We're extremely fortunate to welcome as our guest Emily Taylor, who's been at the epicenter of senior leadership strategy, recruitment and talent management for almost 30 years across Europe and the US, originally with Blackwood and now as the leader of the private market practice with Russell Reynolds. Emily's agreed to take questions, so please do ask through the chat box at the bottom of the screen, and we'll take them at the end of our discussion. So Emily, just by way of context, tell us, how does Russell Reynolds work with private market clients on succession management, and how has that changed over the past 5 years?
Magnus, thank you. It's a great question, and it has clearly changed enormously over the last 5 years. What we see very clearly is that firms handling succession well treat it as an ongoing value protection exercise, not one just triggered by retirement or fundraising cycles. We like to start with strategy and ambition. Where is the firm going? What does the next phase of growth look like? And what kind of leadership does that require? Only then do we assess the internal talent bench and ask 3 very practical questions. Who is ready now? Who could be ready with development? And where are the gaps? That assessment has to be objective. We use structured interviews, psychometrics, 360-degree feedback to move beyond intuition and find a candidly managing partner judgment. We also benchmark internal candidates against the external market. In reality, it's still very rare that firms appoint an external successor. Why? It's kind of obvious. External hires carry greater execution risk, they're expensive, and they can disrupt established teams. As a result, most firms prioritize internal promotions. When succession planning starts early enough, the focus shifts from naming a single ready now successor towards building a deeper, more resilient bench of future leaders. That materially reduces key person or concentration risk and helps to protect value through a period of change. What has really changed over the years is pace. Transitions are happening earlier, firms are bigger and more complex, and LPs are less tolerant of last-minute leadership changes, as we all know. As a result, much more of our work now focuses on how authority is transferred, how successors are tested in visible roles, and therefore how LP confidence can be built with a new team way before a formal handover. For investors, the benefit is straightforward. Succession it stops being a high-risk event and becomes something that can be diligenced and monitored and governed over time. This should mean that there are fewer surprises for everyone.
Thank you. And against that backdrop, I mean, leadership continuity within private market managers has been much greater than in public companies and in many other asset classes. What do you see as being the main reasons for that? And do you think it's a healthy dynamic, or do you think it stifles innovation and opportunity for outperformance, but reduces risk?
We had a long conversation about this. The data here is striking. Academic and industry research suggests that only 6% of GP leaders transition over a 5-year period. The average tenure of GP leaders is roughly 15 years, and for founders, it's closer to 18, 19, 20 years, which compared to US public company CEOs, where the turnover is 5 years, it's well over 5 years is well over 50%, and the average CEO tenure is 7 years. It looks very, very different. Now, my view is that comparison is helpful, but it's not perfect. Public companies and private partnerships operate very differently. When we compare transitions in firms like ours, Russell Reynolds, consulting, law firms, accounting firms, we find that leadership terms are often fixed, typically 3 to 5 years per term, and the expectation to rotate out after a maximum of 2 terms. So tenure in private partnerships is often longer than in public companies, but leadership still turns over more frequently than in private capital firms. So why is this? Why are they different? A lot of it is structural. Private capital is still a relatively young industry. Many firms remain founder-led. Founders often hold concentrated economics and deep personal LP relationships. Add to that the longer fund cycles, the rise of continuation vehicles, and the growing value embedded in GP ownership itself, there are very strong incentives to stay and roll. In simple terms, there's much more at stake financially, which makes stepping back harder. Additionally, GPs are private partnerships that lack independent boards. I know we're going to talk about that later, or advisors who can act as catalysts for change. In the absence of independent voices, difficult conversations around succession tend to be delayed or, candidly, avoided altogether, particularly in founder-led partnerships. Answering your second question, continuity in private markets can absolutely be positive. It supports fundraising confidence, protects relationships, and limits short-term disruption. But it becomes unhealthy when continuity is driven by economics rather than capability or energy. That is where we see leadership benches thin out and succession risk quietly build. The healthiest firms don't frame succession as continuity versus change. So back to your second part of your question, they build continuity through deliberate succession architecture. Potential successors are given real responsibility early, which effectively stress tests future managing partners or CEOs. By the time the titles change, very little actually feels new. Finally, when fund transitions are well prepared, new leadership can be a catalyst for positive change. There are a couple of good public company examples, which we'll come to later.
Thank you. And clearly there's a wide spectrum of ownership structures for private market managers, but a consistent theme has been broadening of equity ownership to include institutional shareholders through public markets, as you've just mentioned, and a number of other cases, but increasingly through specialist staking firms and wider investor participation. How has that broader equity ownership changed successor governance?
Magnus, I feel the introduction of the institutional shareholder should, and to some extent already has, pushed succession much higher up in the governance agenda. I'm not totally convinced that we're there, but compared to 5 to 10 years ago, the difference is that succession is now being discussed earlier and far more explicitly. Shareholders expect succession to be explicit, sorry, I'm going to use that word again, documented and governed rather than assumed. That usually shows up as a clearer succession roadmaps for CEOs, CIOs, and managing partner roles, and a much tighter alignment between leadership change and key person risk, which LPs explicitly underwrite. Key person clauses remain still one of the few hard governance tools that LPs have, but they are very blunt instruments. They do not create succession and have limited redress against failed succession processes. Because of that, we're seeing much more emphasis on proactive planning, LPAC engagement, and succession expectations embedded into GP stake or minority equity agreements.
And you've touched on some of these points already, but what do you think the best firms consistently do well to prepare for and proactively manage succession?
Lovely question. There are a handful of best practices. The single most consistent factor is to start early. Best firms begin at least a full fund cycle ahead of where they expect the change to happen. Potential successors are given real responsibility well before any announcement. And you can see there are different titles being announced. So they run sectors, they run countries, they hire teams, they play visible roles with LPs. This authority comes before title and formal handover. We haven't talked about it much, but we're going to talk about it a bit more now. Economics are also managed gradually. GP ownership, equity, and carry shift over multiple vintages, so newer partners can step in while founders step back in an orderly way, rather than through a single cliff edge event. as we discuss later, GP stakes capital often helps here by providing liquidity without forcing abrupt exits. I do think governance, and we made a joke about this being governance bingo and how many times I say it, but I do think governance underpins everything. Regular partner reviews, independent perspectives where appropriate, and disciplined talent discussions reduce politics and improve objective decision making. Finally, and the LPs on the call will know we've had this conversation, communication matters, and I know that LPs expect clarity. When responsibility evolves visibly over time, transitions feel like confirmation, not a knee-jerk reaction.
Yeah, and just to go into that a bit more detail, fundraising cycles can obviously provide natural punctuation points, but with managers of scale being multi-strategy almost universally and consistently in market, how do you guide managers to think about timing for implementation and communication of leadership change?
Again, great question. The best firms don't let fundraising dictate their succession. I mean, there is never a good time. They treat fundraising as one milestone within a much longer leadership journey. As I've said many times, as we've talked about, this usually means starting earlier than people expect. What does earlier mean? 2, 3 years out, successions are already visible. 1 year out, governance and economics firm up, and LPAC conversations become more structured. By the time a transition is announced, investors have already seen the leadership operating in this kind of role, and any fundraising risks come from surprise, but not succession itself. As you all know, talking about private partnerships is much more complicated on a forum like this, but it's very easy to talk about some of the public examples. So someone like a KKR, you saw it. They planned its transition over several years with Joe Bay and Scott Nuttall, given real authority well before the founders stepped back. Founders then moved into a very clear, defined chair roles, and momentum was preserved and performance continued. At Bridgepoint, the chair and CEOs were separated post-IPO, with founder William Jackson remaining in the business as group chair, while Raoul Hughes, a long-tenured partner who'd worked up through CFO, run the Americas, was promoted from managing partner to CEO. EQT has seen 3 CEO transitions and have done each and every one of them very well, each aligned with a distinct stage in its development. Connie Johnson stepped down in 2014, moving from founder CEO to chairperson after building EQT into a global platform. Thomas van Kock succeeded him, then Christian Sinding, and then in 2025, Per Francine became CEO, continuing EQT's deliberate and well-sequenced leadership of evolution. Most recently, and I think this goes back to some of the new titles, CVC elevated Global Head of Financial Services Peter Brutland into a newly created president role, while Søren Vestergaard Poulsen, a managing partner who co-chaired the private equity board, oversees activity in Greece and the Nordics, was appointed CIO. In all of these cases, the common thread is early preparation, visible leadership, communication, and no surprises either internally or externally.
Yeah, and correspondingly, what do you see as being the main sort of consistent challenges to effective succession management?
Succession is rarely just a change in title. It's a complex mix, as I've said, of economics, governance, and human capital dynamics that make clean execution more difficult. Founders dominance, dependency is one of the biggest risks, I suppose. When founders delay stepping back or empowering successors, authority is not shared and external visibility becomes compressed in a short window. This is when transitions become rushed and fragile. Economics, misaligned economics is another recurring issue. If responsibility moves faster than incentives, leaders disengage or can potentially leave. I think, again, Magnus now sitting in the US and looking at Europe, I mean, the talent benches here are much deeper, but when thin talent benches are around, the kind of great deal doers aren't always the greatest leaders or managers, and actually they don't have the optionality. There is the fear of destabilizing partnerships, fear of losing talent, fear of getting it wrong. It is also very important to recognize the role itself is way more complicated today than it was 20 years ago. Today's GP leaders are expected to be professional managers, not just deal makers. They need to be capable of running growing, complex organization, managing governance and talent, and communicating clearly with LPs. This, 20 years ago, you just had to be a great deal doer. Succession is therefore not just about replacing deal-making capability, but about transferring institutional leadership, which materially raises the bar for getting it right.
Yeah, and just to develop some of those points a little more deeply, how do you support managers in managing succession when there is resistance from incumbent senior leadership for some of the reasons that you've described, and or there's pressure to appoint the strong investors who don't necessarily have the right firm leadership and management qualities?
Yeah, again, I want to say I'm smiling because I see this all the time. I mean, this is, time and time again. I do think the most effective way is to manage this is to depersonalize the discussion and focus on capability. So we talked about strategy and actually ambition for the firm. This is actually where the kind of scorecard around what is the capabilities that you're looking for those leaders. So we aim to define leadership criteria that separates investing from leading a firm. We use independent assessments and extensive referencing to reduce bias. We talked about governance. External governance can play an important part in stabilizing this transition. Some funds already have advisory boards, others don't. Where this works really well in private partnerships is when an external voice is used to support what is otherwise an internal matter. This can also include appointing an external board member or senior advisor, much like firms already do when looking at deals. Development pathways are critical in allowing people to prove capability before elevation. Phased economics can then be used to align incentives, reduce tension, and avoid the risk of shadow leadership. Taken together, the approach leads to decisions that investors can understand and defend candidly.
Yeah. And just thinking about the sort of continuity element we touched on earlier, there's been a range of approaches to the ongoing role that former leadership play post-handover, from a rapid exit stage left to a selection of continuing investment committee involvement or senior advisor role and other variants to provide that continuity. What do you think are the key considerations on which is the right approach?
I don't think there is a single right model for this, I'm afraid. I really don't. The right answer depends on two things: how clear the successor is and what the firm actually needs to do during the transition. There is an obvious uncontested, if there is an obvious uncontested successor who already has credibility with the partnership, and by that I mean real support, and is well known to the LPs, a clean and relatively fast transition can work well. In those cases, the former leader may stay on briefly in a clearly defined advisory or non-exec capacity. If the successor is still building confidence, and there are cultural partnerships dynamics to manage, a more structured and time-bound role for the outgoing leader can also be really helpful. Chair, non-executive, or institutional partner roles can provide continuity and stability, particularly with LP relationships, while allowing authority to move progressively to the new leader. What matters most, I think, in all these cases is clarity. Decision rights, responsibilities, terminants, and economics all need to be explicitly defined. When this is done well, it protects the successor, limits interference, and reassures investors, in my view.
Sure. But just turning to the role of financing in these transitions, as we discussed, the management of the alignment of transfer of equity value with senior management transition has become more complex as the value has grown in these partnerships, and the market's responded with a broad spectrum of equity and credit solutions. How do you see the sequencing and interrelationship of financing and leadership transition?
I think the key starting point is that leadership transition and economic change need to be managed as one integrated process, not as two separate conversations. When these are disconnected, this is where we see transitions tend to fail or stall or just become more and more complicated. The first step is getting the facts on the table. That means mapping current ownership, understanding where liquidity pressures sit, and being clear on what the next generation actually needs economically to take on real authority. Until both the human and the financial constraints are understood, it is very hard to design a workable solution. From there, the focus shifts to structuring. That might involve GP stakes capital, structured buyout, phased carry reallocation, or a combination of all of the above. What matters is that governance is agreed in parallel. Any transfer of economic value has to come with clear accountability, defined succession rights, and an appropriate investor oversight. Otherwise, capital moves faster than control. Implementation then needs to be staged. Financing is deployed in line with a gradual transfer of operational and investment authority, but not all at once. Communication with LPs and, where relevant, public markets investors is aligned to those steps, so confidence is maintained throughout the transition. I think the final phase is stabilization. After the handover, performance and governance needs to be actively monitored and milestones enforced. That ensures the new leadership structure is not just announced, but actually functioning as intended. The principle underneath all of this is balance. Governance without sufficient economic capacity creates delay, as I said earlier. For investors, the value of this phased approach is clarity. It shows how liquidity, incentives, and control are being reconciled in a way that makes leadership transition both financially and operationally executable.
And as I mentioned at the outset, M&A has become increasingly widespread amongst private market managers as they continue to drive growth and leverage their platforms through acquiring complementary managers and strategies. How often do you see this as a response to challenges in managing leadership transition?
I was laughing because having seen Collar sell itself, I think that's one good example. But M&A is one tool amongst many for private markets managers, and when used well, it can generally strengthen a platform. Leadership transition or financing pressure is rarely the headline rationale for a transaction, but it is often part of the underlying context. Most deals are positioned around strategy, scale, capability expansion. In founder-led or first-generation firms, succession and capital structure considerations often sit just beneath the surface. So I think we typically see M&A intersect with leadership or financing challenges in three situations. Founder liquidity and succession, where ownership and decision-making are highly concentrated. A transaction can provide liquidity for retiring founders or senior partners while supporting leadership transition. Balance sheet and economics pressure. Some managers use M&A to gain scale, access capital, improve cost absorption, and stabilize enterprise value. And then I suppose the other bit we've seen, and again, not going to give examples, but fundraising resilience, anticipating tougher fundraising conditions. Some firms may pursue acquisitions or be acquired to broaden their strategy mix, reduce cyclicality, and add growth areas such as infrastructure, credit, or secondaries. This allows them to present as a more diversified platform. Magnus, I would say when M&A is used well, there is a clear strategic logic, a defined post-deal governance model, clarity on leadership roles, and a credible integration plan with aligned economics. When it is not, M&A can increase succession risk by creating overlapping authority, unclear decision rights, and cultural fragmentation. For investors, I think the core question is simple. Is M&A accelerating a well-designed succession or platform strategy, or compensating for the absence of one? I think clear governance, transparent decision-making, and credible integration planning are what give LPs confidence that M&A is strengthening leadership continuity rather than masking underlying risk.
Thank you. Yeah. And Emily, something you touched on earlier is that the skill sets for effective leadership of private market managers have evolved over time. What do you see as being the emerging new capabilities and qualities for successful leaders of private market firms for the next 10 years?
Yeah, this is absolute kind of candy to headhunters. But leadership in private markets firms has evolved very, very quickly, and track record will always matter. But as we've all seen, it is no longer sufficient on its own. You are not just putting your best investors into these roles. The next generation of leaders needs to be able to do the following. I mean, again, talent leadership, attracting, retaining, developing best-in-class investment and operating talent, and building a culture around all of the above and succession. Strategic foresight, setting clear, firm level strategy and being able to anticipate and navigate market and cycle shifts. Operational excellence, running increasingly complex organizations with discipline and efficiency, including professional management structures. Investment judgment, continuing to do the day job at a high level, sourcing, underwriting, value creation, and exits across strategies. Capital raising capability, building durable LP relationships, and articulating a compelling story to raise new funds. And the one that we all know, technology fluency. I mean, leveraging new capabilities, AI, data, to improve decision making, operations, and competitive advantage. I think those are the ones I would highlight most.
Thank you. And we've had a few questions in, but before I turn to those, are there any final thoughts and key takeaways that you'd like to leave our audience with on the key success factors in succession planning?
I think I've said it enough times. I feel I'm being boring, Magnus, so I'm sorry, but succession planning shouldn't be theoretical. It's a necessity. And candidly, it's an intangible protector of current value, as well as creating future value and enabling the business for the future.
Great, thank you.
I'll
just go into the questions that we've had in, and thank you to listeners for providing those. Firstly, how do you see the dual CEO role that we're seeing in some firms? Is it better than a single CEO or managing partner?
I think so. Going back to the complexity of these businesses now, I think as long as roles are clearly defined, I think it enables both co-managing partners still to do deals. So actually, if you look back into the old days, that once you stepped up, and again, we can think of examples, you became the managing partner and you stopped doing deals. Now, actually, the co-managing partners are expected still to do deals. And actually, as long as roles and responsibilities are clearly defined, I think it works very well. So I am a fan. Let's see. We've seen ones that have worked and we've seen ones that haven't worked, but I am a fan because I think the roles have become more complicated, and therefore sharing responsibility enables a better outcome.
Higher hit rate than football clubs.
Yeah, exactly.
But there's a related further question, which is whether it's better to have a non-investment person to be CEO or co-CEO, and if so, whether it creates potential conflicts between CEO and investment team.
Again, great question, and we've now seen the second one. So if we think about, there are two examples, one of which has happened very recently, where they've used the old either head of fundraising or capital markets or a COO type role. Again, I think, Magnus, this goes back to actually the two different roles. One is we're very much a CIO type managing partner role, and the other one is responsible for everything that is not on the investment side. So I think it works very well. And one of my favorite quotes recently is that investors are no longer just be good at investing, they need to be better at fund management. And actually, if you've got somebody who is better at looking at the investments in the round, i.e. exit committees, and actually what best in class fundraising looks like, and actually how you're going to fundraising. I think if you're only investors sitting at those kind of co-managing partners, I don't think you get the breadth of the expertise in the organization.
Sure. And another question has been what the optimal profile for non-executive directors of private market managers, and when the right time for GPs to introduce them is.
It's a great question. Now, is I would say, again, being self-serving as a headhunter, I like those roles. They're really good. I think it's interesting. I think the GPs right now are defining what exactly they want these people to do, and then therefore by default, where do these people need to come from? Where I find it interesting, and you talked about football clubs, so I'm going to talk about football clubs, changing a jersey from a Man United to a Man City. So going from being an investment partner at firm A to firm B as a non-exec, I think is quite complicated unless you're clearly going from, a larger scale to a mid-market scale or whatever it happens to be. But I think at the moment, most of the non-exec roles that we're seeing are former investors from other businesses. I'm hoping that expands, but it does depend on the definition of exactly what it is that they're looking for these people to do. Is it to say, look, I worked at XYZ firm as it scaled, therefore I understand what it's like to set up new strategies or acquire businesses? Is it somebody who's going to help them define a better exit strategy? What is it? Is it internal or is it external, I suppose, is what I'm going to say around those non-execs. But at the moment, when we see non-execs, it's people looking for other former investors who've been there, done that, got the T-shirt.
Thank you. Another question has come in, which is on, and I leave it to your discretion whether you anonymise these, but there's a question as to whether you can provide examples of where succession management has gone wrong and the impact it's had on the firms.
Am I allowed to take the fifth on that one? I think I would have no business left if I highlighted that. I'm gonna flip it around and actually answer it in the positive, because I think that's important. When it's worked well, it has been done. And again, we talked about timing, doing it early in advance. Where I've seen it work well is when the person who's been anointed is unanimously agreed by the other partners. And actually, some of that has been done in a negative way, which is if any of the other partners got promoted to co-managing partner, the rest of the partnership would resign. So there's the kind of lowest common denominator on that. But in most of the situations we're seeing now, it is very clear that every one of the other partners doesn't want the job and is behind the partner that's been elevated. So, and this bit around getting people ready 2-3 years out and actually developing skill sets, where it doesn't work is when the person who's been elevated doesn't have the support of the locker room. So that is the bit that I'm seeing more and more, where people are turning around and saying, I don't understand that promotion.
Great. Well, thank you, Emily. There's been fantastic insights on what's a really, really important subject, and thank you to all our audience for listening today. Thanks, everybody.
Thank you for having me.